There's a man in your city, maybe your neighborhood, who drives a 7-year-old sedan, wears the same 3 rotation of jackets, and hasn't posted on social media since 2019. He also owns the building you work in, and the one next to it, and a portfolio of index funds that throws off more in annual dividends than most people earn in salary. Meanwhile, someone else just pulled up in a leased sports car, fresh from a photo shoot with stacked cash they borrowed for the afternoon. Their follower count is climbing. Their net worth isn't. In fact, if you subtracted their debts from their assets, you might find they're worth less than the barista who made their oat milk latte this morning. This is the great inversion most people never see. The loudest displays of wealth are often the weakest signals of it. And the people building real, generational fortunes, they're doing it so quietly, you'd never notice unless you knew exactly what to look for. The flashy car isn't a sign of arrival. It's often a sign of someone desperate to look like they've arrived. And that desperation, that need to perform wealth rather than build it, is one of the most expensive mistakes a person can make. Let's talk about why silence wins, what the loud approach actually costs, and the specific mechanics that allow quiet wealth to compound while noisy wealth evaporates. First, we need to understand something counterintuitive about money. Spending it and having it are almost opposites. This sounds obvious when stated directly, but watch how people behave, and you'll see that almost no one actually believes it. We're surrounded by messages equating wealth with consumption. Rich people buy things. Therefore, buying things means you're rich. The logic feels airtight until you examine it for 3 seconds. Every time wealth becomes visible, through cars, watches, vacations, designer, anything, it stops compounding. It moves from your asset column to someone else's revenue. That's not a moral judgment, it's just math. $100,000 spent on a depreciating luxury is $100,000 that will never double, then double again, then again. Let's slow down on that compounding point, because it's where the entire game is won or lost. If you invest $100,000 and leave it alone, earning a historically average return, here's roughly what happens. In 10 years, it becomes $200,000. In 20 years, $400,000. In 30 years, $800,000. In 40 years, over $1.5 million from a single initial sum you never touched. Now imagine instead, you spent that $100,000 on a car. In 10 years, that car is worth maybe $15,000. More likely, it's been replaced by another expensive car, which will also depreciate, requiring another purchase, then another. The person who bought the car didn't just lose $100,000, they lost the $1.5 million it would have become. This is the silent tax on visible wealth. Every flashy purchase doesn't just cost its sticker price, it costs everything that money would have generated for the rest of your life. The quietly wealthy understand this at a bone-deep level. They've internalized something most people resist. Wealth isn't what you display, it's what you retain. This is why so many genuinely wealthy individuals are almost aggressively ordinary in appearance. They're not performing restraint for admiration. They simply recognize that visibility has a cost, and they'd rather pay for assets than attention. Warren Buffett still lives in the house he bought in 1958 for $31,000. Ingvar Kamprad, who founded IKEA and was once among the richest people in Europe, drove an old Volvo and flew economy class. These aren't publicity stunts. They're expressions of a worldview that sees spending as a leak in a system designed to compound. Now here's where it gets interesting. Loud wealth and quiet wealth aren't just different spending habits. They represent entirely different operating systems for how money grows. Loud wealth operates on what we might call the attention economy. Success is measured in recognition, status, and social proof. The goal is to appear successful, which in theory attracts opportunities, partnerships, clients, followers, and deals. And sometimes it works. Visibility can be a legitimate business strategy. Influencers really do get brand deals. Flashy entrepreneurs really do attract investors sometimes. The attention economy is a real economy, with real money flowing through it. But it comes with a structural problem. You have to keep feeding the machine. The car can't get older. The lifestyle can't downgrade. The content can't stop. You're locked into a spending treadmill just to maintain the image that supposedly generates the income. Miss a month, look less successful than last year, and the whole apparatus starts to wobble. This creates a deeply unstable financial position disguised as success. You're not building wealth, you're renting the appearance of wealth, and the rent is due constantly. Quiet wealth operates on a completely different axis: ownership and compounding. Instead of trading money for status, the quietly wealthy trade money for assets, things that generate more money while they sleep. Rental properties that produce monthly income whether the owner posts about them or not. Equity in businesses that grow whether anyone's watching or not. Index funds that capture market returns year after year with no performance required. Royalties and licensing agreements that pay out based on usage, not visibility. The goal isn't to look rich, it's to own things that make you richer, whether anyone notices or not. This is the critical fork in the road. One path trades wealth for the appearance of wealth, the other trades appearances for actual wealth. Over 10, 20, 30 years, those paths diverge so dramatically they become different universes entirely. Let's make this concrete with a detailed comparison. Consider two people who each come into $500,000 at age 35. Maybe it's an inheritance, maybe it's the sale of a small business, maybe it's stock options that finally vested. The source doesn't matter. What matters is what happens next. Person A decides this is their moment to upgrade. They buy a house in a more visible neighborhood. Bigger mortgage, higher property taxes, increased maintenance costs. They get the car they've always wanted, maybe two. They join the right clubs, which have membership fees and social spending expectations. They upgrade their wardrobe, their vacations, their entire presentation to the world. Within 18 months, most of that $500,000 has been converted into lifestyle. Some assets, but mostly depreciating goods and increased monthly obligations. Their life looks dramatically more successful. Their net worth is barely different from before, maybe worse once you account for the new debt. And here's the trap. Their lifestyle now costs significantly more to maintain. They need to earn more just to stay even. If their income dips, they face an ugly choice between visible downgrade and financial stress. They've built a life that requires constant high performance just to sustain the image of success. Person B does something boring. They sit down with a spreadsheet or a financial advisor and think about what they actually want their money to do. They put most of it into a diversified portfolio, maybe broad market index funds across multiple geographies, some bonds for stability. They might acquire a small rental property, something modest that cash flows from day one. They continue living more or less as before. Maybe a few small upgrades, but nothing that would catch a neighbor's attention. No one notices. Nothing changes visibly. Person B's friends might even feel a little sorry for them, wondering why they didn't do something exciting with their windfall. But here's what happens quietly. At a conservative 7% annual return, that invested money roughly doubles every decade. The rental property generates income while appreciating in value. The portfolio throws off dividends that get automatically reinvested, buying more shares, which throw off more dividends. By age 45, Person B's investments have grown to around $1 million. They didn't do anything clever. They just didn't disturb the compounding. By 55, it's closer to $2 million. Still boring. Still invisible. Still growing. By 65, Person B is sitting on $4 million they barely think about, while Person A has spent 30 years on a treadmill trying to maintain an image that cost them the very wealth it was supposed to represent. Person A might still look more successful, but Person B could buy Person A's lifestyle in cash and still have more left over than Person A ever accumulated. Person B didn't win because they were smarter or worked harder. They won because they understood that wealth is built in the silence between transactions, not in the transactions themselves. There's another dimension to this that rarely gets discussed: the psychology of noise. People who build wealth loudly often do so because they need external validation to feel successful. The display isn't just marketing, it's emotional regulation. They need others to see their success for it to feel real. Without the external confirmation, the compliments, the envy, the attention, the achievement feels hollow. This is a profoundly expensive psychological dependency. It means that money can never simply be money. It has to be performed. Every financial decision becomes filtered through a question that has nothing to do with building wealth. How will this look? What will people think? Does this communicate success? That filter systematically biases decisions toward visible spending and away from invisible investing. It makes you choose the expensive restaurant where you might be seen over the modest one where you won't. It makes you buy the brand name that signals status over the equivalent product that doesn't. It makes you invest in flashy, exciting opportunities you can talk about at parties rather than boring index funds that make for terrible conversation. The cumulative cost of running every financial decision through a visibility filter is staggering. You don't notice any single choice costing you much. But over decades, You've leaked hundreds of thousands, maybe millions in wealth that disappeared into the performance of wealth. The quietly wealthy have severed that connection. Their sense of financial security doesn't depend on anyone else's perception, which means they're free to make decisions purely on merit, buying when others are panicking, holding when others are showing off, investing in unglamorous opportunities that happen to have excellent fundamentals. This psychological independence is arguably more valuable than any specific investment strategy. It removes an entire category of expensive mistakes from the equation. When you don't need anyone to see your success, you stop paying the visibility tax that quietly bankrupts so many people who look successful. Here's something else the loud approach misses entirely: optionality. When your wealth is visible, you become a target in ways both obvious and subtle. Tax authorities pay closer attention to people who display wealth. This isn't paranoia, it's simple resource allocation. If you're trying to find unreported income, you start with people who appear to have money. The person driving the old sedan isn't getting audited. The person posting yacht photos might be. Lawsuits become more attractive when the defendant appears wealthy. Attorneys working on contingency are making a calculation. Can this person pay if we win? Visible wealth answers that question definitively. Hidden wealth leaves it ambiguous, which often means the lawsuit never gets filed. Business negotiations shift when the other party knows you're rich. Vendors quote higher prices. Partners expect you to contribute more. Employees expect higher salaries. Every transaction starts from a position of assumed abundance, which is the exact opposite of where you want to start any negotiation. Family dynamics warp around visible wealth. Relatives develop expectations. Requests for loans materialize. Relationships that were previously simple become complicated by financial undercurrents. Every interaction carries a subtle charge it didn't carry before. Quiet wealth preserves options that loud wealth forecloses. You can walk away from bad deals because no one knows you can afford not to. You can negotiate harder because there's no public image contradicting your position. You can give generously without creating expectations of future giving. You can invest without attracting copycats who bid up prices. You can make mistakes without an audience. The wealthy families that persist across generations almost universally understand this. They structure their holdings through trusts and corporations that obscure ownership. They keep their spending modest relative to their means. They maintain minimal public profiles, not out of shame but out of strategic awareness. They know that visibility is expensive, and they didn't build multi-generational wealth by paying unnecessary costs. There's a reason you can probably name the flashy billionaires but not the quiet ones. The quiet ones have designed their lives specifically to avoid being named. So what do the quietly wealthy actually do with their time, if not displaying success? They build systems. This is perhaps the most important difference between the two approaches, and it's almost entirely invisible from the outside. Loud wealth requires constant personal performance. You have to hustle, network, stay visible, maintain the image, create content, attend events, be seen. Your wealth generation is tied directly to your personal effort and presence. Stop performing, and the income stops, or at least the image collapses, which in the attention economy amounts to the same thing. Quiet wealth is constructed through systems that operate independently of your daily effort. A business that runs without you. Not a business you own on paper while working 80 hours a week inside it. A business with management, processes, and structures that generate profit whether you show up or not. This is the difference between owning a job and owning a business. And it's a difference measured in millions over a lifetime. Investments that compound without supervision. Index funds don't need you to watch them. Dividend stocks don't need your attention to pay dividends. Bonds pay interest whether you check your account daily or yearly. The entire point is to create wealth that grows through mechanisms, not effort. Intellectual property that generates royalties while you sleep. A book written once can generate income for decades. Software built once can be sold thousands of times. A patent licensed once creates a stream that flows without ongoing work. These are systems that convert past effort into ongoing wealth. Real estate that appreciates whether you're paying attention or not. Property in growing areas tends to increase in value through market forces, not owner effort. Rental income comes monthly based on leases, not daily hustle. A well-structured real estate portfolio is a machine that produces cash. The goal isn't to work harder than everyone else. It's to build machines that create value without requiring your constant presence. And building those machines is slow, unglamorous work that offers almost nothing to show off for years, sometimes decades, until suddenly it's generating more than your labor ever could. This is the silence that builds wealth, not meditation retreats or motivational quiet. The literal silence of assets working in the background while you live your life. The absence of noise because the system doesn't need your attention to function. From the outside, it looks like nothing is happening. From the inside, everything is happening, just without sound. There's a Japanese concept called kaizen, continuous small improvements. The quietly wealthy apply this relentlessly but almost invisibly. They're not making dramatic moves. They're making small optimizations constantly, in every direction. A slightly better interest rate on their savings, maybe an extra 0.5%. That doesn't sound like much until you calculate it across hundreds of thousands of dollars over decades. Then it's tens of thousands in additional wealth from a single phone call or account switch. A small efficiency in their business operations. Reducing costs by 3% doesn't make headlines, but it flows straight to the bottom line, year after year, compounding into significant sums. An extra percentage point in their investment returns through lower fees. The difference between paying 1% in fund fees versus 0.1% seems trivial, but over 30 years on $1 million portfolio, that difference is hundreds of thousands of dollars, paid to fund managers instead of compounding for you. Tax optimization that saves a few thousand annually. Not aggressive avoidance, just intelligent structuring, using retirement accounts fully, timing capital gains, taking legitimate deductions. Each saves a small amount, but small amounts invested over decades become large amounts. Better insurance rates through shopping around, lower mortgage rates through refinancing at the right time, reduce subscription costs through periodic audits. None of these are impressive individually. None make good social media content. No one's filming a video about how they saved $80 a month by switching insurance providers. But compounded over decades, these quiet optimizations create gaps that flashy spending could never close. While the loud approach optimizes for impressive moments, the big purchase, the dramatic reveal, the enviable experience, the quiet approach optimizes for trajectories. Tiny improvements to the slope of a line that, given enough time, ends up in a completely different place. The loud approach focuses on peaks. The quiet approach focuses on slopes. And slopes always win, given enough time. Let's talk about the social environment that makes loud wealth so tempting, because understanding the trap is the first step to avoiding it. We live in an era of unprecedented wealth visibility. Social media has created a global stage where anyone can broadcast their lifestyle. And the algorithms reward the flashy, the exotic vacation, the luxury unboxing, the expensive purchase, because these generate engagement, and engagement is the currency of attention platforms. This creates a systematic bias in what we see. The quiet millionaire never posts their portfolio. The flashy person with a negative net worth posts everything. So our perception of what wealthy people do is constructed almost entirely from the behavior of people optimizing for attention, not wealth. We're essentially taking financial cues from the people least qualified to give them. This visibility also creates comparison pressure that didn't exist in previous generations. Your parents might have felt some pressure to keep up with their neighbors, the people they actually saw regularly. You're now comparing yourself to curated highlights from millions of people worldwide, filtered for maximum impressiveness. You're comparing your actual life to everyone else's highlight reel and finding yourself wanting. This pressure is expensive. It's designed to make you feel inadequate, so you'll spend money to feel adequate. And it works on almost everyone, at least a little. The quietly wealthy have either avoided this trap or escaped it. They've recognized that the comparison game is rigged, that the scoreboard is fake, and that winning at the wrong game is worse than not playing. They've found ways to feel secure in their financial position without needing others to validate it, which is both psychologically healthier and financially superior. Here's the uncomfortable truth underneath all of this. Building wealth in silence requires being comfortable with something most people find intolerable: delayed recognition, maybe permanently delayed. The possibility that you'll never get credit, never get admired, never get the external validation that loud wealth promises. You have to be okay with your neighbor assuming you make less than you do, with old classmates thinking you never really made it, with strangers not treating you as important, with the world underestimating you indefinitely. Your wealth exists, but in forms no one can see, numbers in accounts, equity in entities, value in assets that don't announce themselves. You know what you've built, no one else does, and you have to make peace with that gap. This is psychologically challenging in ways that aren't obvious until you're living it. Humans are social creatures. We've evolved to care about status, about our standing in the group, about how others perceive us. Fighting that instinct requires constant effort, and most people eventually give in. That's the price of the quiet path, and it's why most people can't stick with it, even when they intellectually understand the math. They know compounding beats spending. They know silent wealth outperforms loud poverty. They know the attention game is expensive, but knowing and doing are different things, and the pull of recognition is strong. But for those who can make peace with invisibility, the rewards aren't just financial. There's a particular freedom in building something real while the world looks elsewhere. There's a lightness that comes from not needing anyone to see. You're not performing. You're not anxious about maintaining an image. You're not calculating how each decision will be perceived. You're just building, quietly, according to your own standards. There's a security that doesn't depend on performance. If your income drops, you don't face a choice between financial stress and visible downgrade because you never upgraded visibly in the first place. Your lifestyle isn't a prison. Your expenses aren't a treadmill. You have margin, flexibility, options. There's a clarity in financial decisions that people playing the visibility game never experience. Should you make this investment? The question is simply whether it's a good investment, not whether it's impressive, not whether it signals success, not whether you can talk about it at parties. The decision gets to be purely financial, which means it gets to be purely rational. And there's the compound wealth itself, growing quietly in the background, year after year, decade after decade, until it reaches a scale that loud wealth could never match, because loud wealth kept spending what quiet wealth kept compounding. The loud world will keep performing. The yachts will keep getting photographed. The luxury brands will keep getting unboxed. The attention economy will keep rewarding flashiness with visibility and visibility with more attention, in a cycle that looks like success, but often isn't. Meanwhile, somewhere quiet, someone is buying their fourth rental property with the proceeds from the first three. Someone is watching their index fund cross into seven figures. Someone is living well below their means by choice, not necessity, growing wealthier every month through mechanisms that don't make noise. In 20 years, when someone asks how certain people built what they built, the honest answer will be almost disappointingly simple. Slowly, silently, and while no one was paying attention. The formula isn't secret. Spend less than you earn. Invest the difference in assets that compound. Avoid the visibility tax. Resist the comparison trap. Let time do the work. It's just that following the formula requires giving up something most people can't bear to part with: the need to be seen winning. Those who can make that trade will build real wealth. Those who can't will spend their lives performing it. If this gave you something to think about, consider subscribing. We explore how wealth, systems, and strategy actually work, without the hype, without the performance, and without pretending that flashy is the same as successful. See you in the next one.